let's go on to our first point, and I guess I bring back your point around, you know, every supplier in that wider supply chain, and I think it's a really good time now to talk about access to finance and financial inclusion. And Claire, perhaps I'll start with you. There's no doubt that some of the hardest hit businesses from the pandemic have been female-owned and minority-owned businesses, particularly in emerging and developing markets. How can the trade industry support financial inclusion to those hardest hit?
Yeah, no, I absolutely agree with you, Dipesh, and I'm sure, you know, the rest of the panelists have seen the same. Obviously, when this started, well, 18 months ago, 20 months ago, I stopped counting, I'd just say 2 years by now. You know, there was a lot of financial confidence, you know, confidence was lost. You know, initially there was, you know, a little bit of paralysis about what to do next. And the practical situations were, you know, we were in a kind of a lockdown situation in many of these countries, whether that's lockdown from supply chains mobilizing, you know, the ports were getting congested, and whether that's physical lockdown of being literally locked down in our homes, right? So women have always lagged in terms of the financing availability they've got, right? Whether through all different forms of financial institutions. And so that just kind of compounded the situation. You know, women, as you know, we traditionally do, have been juggling many things, right? Just really practical things, right? You know, you can't rely on the extended family, you know, to continue managing your business. The access to childcare, you know, we were juggling, as you know, men and women are all doing, we're juggling everything from their home. So that really compounded the situation, and I would say across emerging markets, but also in industrialized nations. And so the key is that the time to act, and as Natasha said, we did see, I would say, compared to the financial crisis, we did see action a lot sooner than we did, you know, 10, 12 years ago. But there's still a long way to go. I mean, a couple of the things that I think were impactful that we see across the board were really about kind of making sure that you set yourselves goals around kind of continuing to support inclusive support. So at MasterCard, we'd set ourselves a goal 5 years ago to increase 500 million companies and individuals into the digital economy. Given what was going on at COVID, we decided in the middle of COVID to reset those goals, to extend that 500 million to 1 billion. Included in that is 50 million small businesses, of which 25 million are women owned. And the key is just like, we're not doing that alone, right? We're making ourselves accountable. So the other piece of this is the power of partnerships, right? So working with the banks, working with the development banks, working with the technology companies like Finastra, is we're enabling data, finance, and technology to come together, right? And we did some work, we've just announced with IFC and Coca-Cola to support micro retailers and the wholesale distribution program out in Indonesia. And so I think that just evidenced the power of partnerships and coming together at a time like this, which we continue to see.
Thanks, Claire. So I guess we'll go into a bit more detail and talk about the actual supply chain finance operations, and perhaps Natasha's JP Morgan view would be really good here. Natasha, how's supply chain finance evolving to meet some of the needs of all organizations of the value chain, to your earlier point?
Sure. So, I mean, starting from first principles, right? Supply chain finance as it is intended to work, and I'm talking obviously about the solution where a large buyer allows for a financing solution to allow their typically smaller suppliers to receive some earlier payment, earlier funding than they otherwise would with the help of a bank or some other party in between. You know, that solution at its best and the way it should be designed has always been intended for the benefit of the supplier. The supplier gets paid earlier than they otherwise would have done. They get a liquidity benefit. They get often a working capital benefit if that structure is set up correctly. And so you're taking advantage of the arbitrage of one big anchor corporate who's the buyer, who typically has a great credit rating, can borrow at really competitive pricing, and has just more firepower with the banks than a typical small supplier. So as a solution, it's absolutely designed to support suppliers, and the benefit to those suppliers tends to be greater the smaller those suppliers are, because their own access to liquidity on their own bank lines is typically more limited, and therefore being able to use a big corporate customers' lines is a proportionately bigger advantage. So it's always been a solution that lends itself very nicely to supporting a supply chain, to supporting small companies. What I think has really changed about it now in recent years, and particularly exacerbated by COVID, is two things. One of them is, you will not be amazed to hear anyone say this, is the digital revolution, right? So nowadays with technology, you can do all kinds of things that you couldn't do before. You can offer financing solutions to smaller companies where it used to be very, very hard to onboard them to this kind of solution. And that kind of sort of digital partnership, JP Morgan works with a fintech called Taulia, and some of the capabilities that they bring to the table allow for the onboarding of, very much smaller suppliers perhaps than would have been able to access that kind of solution some years ago. And so then it becomes not just a financial benefit between a mid or a small size corporate and a large one, but a financial inclusion tool that is actually pushing financing out to companies that would not have been able to access it before. And that, I think, is very exciting and ties into kind of some of the stuff that Claire was talking about just now. The other development that I've seen on the supply chain finance side, which also ties in very tightly to what Claire was talking about just now, is that digital has allowed corporates to kind of target that kind of benefit much more tightly than they used to be able to, which means that they can tie the financing to things like ESG goals. So if what they want to do is to support, for example, specifically suppliers who are minority owned, women owned, disadvantaged in some way, nowadays you can do that, right? You can measure which ones of those suppliers you have, you can feed that back into the financing program. In the same way, if you have environmental goals, I'll just give you an example, the deal which we can talk about publicly with Bridgestone, where Bridgestone set up a structure with JP Morgan and Taulia, where they have a third-party environmental auditor that checks the sustainability status of the suppliers. And if that auditor, EcoVadis, has evidence that those suppliers are improving their environmental performance, that comes back through an API into the Taulia front end, and they get a financial incentive through the supply chain finance program. So you're actually helping to mitigate the costs of going green for these small companies that otherwise would really struggle with it. So it's already part of the digital revolution. It's just that the way people are starting to use those digital capabilities is really exciting. And so you can do stuff with supply chain finance that you could not possibly have done as much as 3 years ago.
Thanks, Natasha, and some really great examples of adapting your products to your corporates and of course their suppliers. But no disrespect, JP Morgan is a very large bank with lots of kind of capabilities. And a question for Brian: how can we democratize the industry to ensure some of those smaller banks get access to supply chain finance and other types of financing?
Well, Natasha's hit on one of the key capabilities, which is technology. So we talk about digitization, but really it's the use of many types of technology. So that's number one. The second area that is the regulatory area. I think the getting clarity about, certainly on supply chain finance, what it means and how to treat it. I think the industry needs to help there, and finally with collaboration. But if I can go back to technology, certainly for the smaller banks, I think technology has been an area of fear for them. Whenever they see a new technology or they want to implement something, they see this as a relatively large project. They see the fact that they need to upskill on the technology, not necessarily the application of the technology, but the technology, how to support it, how to run it, how to work with third parties to understand that technology and manage it. And I think the industry is changing. We and other organizations now provide that technology as a service, as a subscription service. So they don't have to worry about what artificial intelligence is or machine learning is. They just get the benefits of the application of that technology to their business. And I think that's going to be a key parameter going forward, is educating maybe the smaller banks that it's not really the technology that they need to look at, it's the application of that technology, and to view them as services that they can use in their business going forward. On the regulatory side, I think there's we're seeing it now, and I'm sure the bankers and the other panelists will talk about this, but there was been some conversation around how to treat supply chain finance internally, how to book it, how to view it, how to manage it. And I think for the smaller banks looking and reading about this, there was some reticence maybe to embark on supply chain finance programs because of that lack of clarity of how to treat it. But the third area really, I think, is collaboration. I think for the smaller banks, it's about collaborating with other organizations, maybe some of the bigger banks, to provide a true end-to-end supply chain finance program, working together, where they can fill gaps that maybe the larger banks can't reach into. They understand their local customers very well. They are their customers after all. So I think the industry working together in a collaborative way will certainly help the smaller banks to be more inclusive in terms of who they work with, but also to be part of the wider supply chain finance solution.
Thanks very much, Brian. And now I'm going to go on to Susan, and actually a question from Mark Christian Villas on LinkedIn, and Mark comments that supply and demand has changed, resulting to change in fiscal and monetary policy. How do we get through this, and how can global trade help kind of alleviate some of the things that we've seen? And also, Susan, if you can talk through the recent IFC survey results that you guys did on correspondent banks when it comes to access to finance in emerging and developing countries, that would be great. If I can get the guys to pop the slides onto the screen.
Sure. And first, to the question, our audience member is completely correct. You know, what we've seen as we've watched this carefully over the last almost 2 years, I think, as Claire mentioned, you know, in the beginning as the crisis unfolded, and not just private sector players, but also the government level of intervention was quite impressive and quite rapid, shows some learning from the global financial crisis. But what we're also finding is that that these sort of federal coffers are wearing thin because they've had to continue to support with sort of fiscal stimulus or just fiscal maintenance what's going on in the crisis at this time, and trying to keep their economies alive, not thriving or growing, but just alive. And so what we're finding is that the more money that's spent to help maintain activity during the crisis, the less money there may be to accelerate out of that crisis once it does abate. And that's when, you know, our sense is that there's a huge role for multilaterals, but beyond that, there's a huge role for the extended private sector to come in and help fund this eventual recovery, and to help to expedite that. You know, we're all of us, even on this call, and those beyond us, have been involved in helping to try to break the falls. We call it raising the floor for some of these economies in crisis. But our job isn't done at that point. There's the recovery has a great opportunity actually to shift the development trajectories of many of the markets that have been struggling or challenged for some time. And the only way that's going to be realized, that potential will be realized, is with full engagement of players, cross-border players, effectively in trade finance and supply chain finance across the world. But moving quickly to my slides, Deepesh, I'm mindful of the time, so I probably will not go through all of them. For the last decade or so, IFC has conducted an annual survey of its trade finance emerging market client banks. We've done 2 during COVID, one the first half of 2020, right in the thick of things, as well as one covering the first 7 months of 2021. We call that hot off the press. You see some other publications there, including a distinct trade and trade finance trilogy. This survey covered, as you see, 151 issuing banks across 64 developing market countries. I wanted to note that this covered all regions, and it's roughly half and half on emerging market size. So between the lowest income emerging markets, I've seen some participants in some of these countries on the call today, and some of the larger or middle-sized emerging markets as well. So moving to the next slide. Yes, and this is where I'll spend my time. This is the most important slide of the collective piece. By the way, this has not yet been published. So everyone on the call is the Trade Finance Global audience is getting a bit of an early glimpse of what's to come. So we give Deepesh the rights to the first public presentation. But one of the most important challenges in COVID, what's important to know is that they persist. So we're all optimistic and hopeful. As a matter of fact, all of our banks are that the world will return to better than normal at some point, but we are not there yet. And so I'd like to pause. The most important challenge is reflected in that second headline number, or the first headline number on the top left. And it's actually inspiring for us to see how banks all over the world, including those on this call, have put their people first. And that's a mark of true leadership. So over 84% of our emerging market banks mentioned concern for staff's well-being and customers' well-being in 2020, right from the start of the crisis. That actually motivated the expedited digital shift in a way. This has not changed in 2021. Those concerns are still valid. Also, at the bottom headline number there, that 95%, those are the percentage of emerging market trade finance banks that noted that customers were negatively affected by COVID. No surprise there. Only a slight decrease from 2020's 98%. But what we do see is that businesses are facing pressure on all fronts, including those supply chain participants, as demonstrated by the sheer number of issues identified. And you see those listed or summarized on the bars to the right. The top set of bars provides details on financial challenges that customers faced. 93% of our banks mentioned that customers were in crisis versus only 91% in 2020. And while we do see some changes among those improving in 2021, that's the darker blue bar. But if you look very closely at those values circled in red, the fact is that they're all quite high. We don't see, this is a triple, quadruple the percentages that we see in normal years. And so then also take a look at that second bullet point in the left blue shaded box. This is the most important point of the presentation in terms of astronomical shifts in market data. So 65% of banks reported liquidity constraints or limitations in 2021. That's versus 33% in 2020, which at the time, 33% was quite significant. And then if we bounce back to the bottom right with the operational challenges on the chart below, 91% of our banks indicated at least one customer had operational challenges. No surprise there, but the figure is still higher than 2020. Again, still exceptionally high. And if you look at the list of operational challenges that are faced by those that are actively in the middle of these supply chains, we see value chain disruptions, export demand issues, export production issues, securing raw materials through imports. These don't even show up. They don't make the list in normal times. And so this tells us that, that COVID, while we do see some bright light, we see some export demand starting to emerge with that shift from 71% mentioning problems to 62%. What we do see is that that's a fledgling sign for a recovery, and it gives us hope, but we are not out of the woods yet. I don't think we're going to have time to go through the rest of the slides, but I do want to note that correspondent banking stress, not on the slide, is continuing to increase. And we see that in several places on our survey. We define correspondent banking stress as not the number of a simple line count, but everything, all of the activity that goes within that line, with line limits, with tenor limits, with cost of financing, with throughput speed from request to approval, and several other pieces, the availability or the compression of products being covered across borders. And we did see that increase substantially over the last 2 years. That's no surprise. Banks reporting some form of CBR stress went from 10% 10 years ago to 39% in 2020, and then up to 81% in 2021, including a large portion of the banks that have been stress-free in 2020. Most of them, again, when we look at that through a liquidity lens, which is what you see on this slide, is that even asking outside of the tell us about your CBR stress kind of questions, what we're seeing is pressure on those, when I say CBR, I mean correspondent banking relationships. And what we see is sort of the top drivers of liquidity challenges are related to those incredibly important cross-border lines. So financing cost, a desire for longer tenors, and a desire for increased line limits. Now, that's not a crazy set of requests. Any banker worth his salt is going to be asking for these things. But what we do see is the frequency of these mentions and these asks have risen exponentially.